And what we are doing, what we're going to feature right now are two companies that are really trying to make a difference in solving this problem. You know, many of you know the great work that ZestFinance is doing in the space. They're really one of the leaders when it comes to using AI and machine learning to really help expand the credit box. And also Discover. Everyone knows Discover. They've got a massive credit card portfolio. They've also been doing personal loans for some time. And these two companies came together. They just announced it a month ago. We wanted to feature them on stage here to really delve into how they're actually going to really provide this roadmap for really providing credit for another billion people. So please join me in welcoming Douglas Merrill from ZestFinance, Roger Hochschild from Discover, and Selena Wang from Bloomberg. Sir.
And it's a hot one. Excellent. Like 7 inches from the midday sun. Well, I hear you whisper and the words melt everyone.
So we were just talking about that partnership earlier, which you just announced quite recently. So essentially using ZestFinance's AI and machine learning to improve Discover's credit underwriting capabilities. So Roger, talk to us a little bit about how that's working.
You know, it's working great. I think as you think about AI and machine learning in financial services, it will transform every part of the business. And so if you are a bank or in financial services, you need to make sure you're working with the best and the brightest. And that's what brought us to work with Zest.
Of course, you probably wouldn't have answered if you thought we stank.
That's right. So we'll see how it goes.
I heard there's some dispute around this, but how exactly, Doug, did the relationship come about?
So I think the dispute is kind of where it started. So I think our first conversation with Discover was when I rudely interrupted when Roger's predecessor was having a cup of coffee, and I kind of broke in and introduced myself. It was extraordinarily awkward because like I'm anything if not conversationally smooth. So, and then like 2 years went by and kind of nothing happened until finally we got reconnected. So I think I think Discover has a slightly different perspective of how it started.
Yeah, no, I think that might have been the first start, but Douglas met Carlos Minetti, who runs our non-card lending division. We started to build a relationship. Douglas, we had him speak to our board of directors, and then the partnership has continued to build.
Now, Doug, let's dig down into this a little bit. So what data points are you looking at that Discover didn't already before? And in test trials, what exactly are you learning?
I mean, so I'm probably going to be a little bit careful talking about Discover's data because it's not my data, and just to make sure we're all in sync. I don't sell models. I don't sell data. What ZestFinance does is sells a set of tools to help organizations build their own models and then figure out how to deal with their regulators and their internal model validation folks, et cetera. So we sell a toolkit. In Discover's case, we also helped build their first generation of models. And it's not always looking at kind of new data, like, oh, I have to go out and buy new data, although that sometimes happens. It's often the case that you can look at trending data or interactional data that are a little hard to do in traditional mathematics that you can do with the mathematics our tools support.
And Roger, how are you expecting this to expand not only the bottom line, but also customer opportunities? According to some of the most recent publicly available data, personal loans were some of the most challenging areas for Discover.
Yeah, I think personal loan underwriting is extraordinarily challenging. Part of it is the credit side. Part of it is, I think, what shows up as credit losses but can frequently be fraud. So manufactured identities, account takeovers, that type of thing. And so that's one of the first areas, because of the challenges from traditional modeling techniques. That's one of the first areas we wanted to focus on and build our partnership. You know, it's a business we've been in since the mid-2000s. It's an important part of our diversification beyond card. But, you know, in the credit card business, you can manage the credit line on an ongoing basis. In a personal loan, you just got that one decision up front. The money goes out the door, so you have to make sure you get it right.
And prior to working with ZestFinance, was Discover already applying AI and machine learning to some of the underwriting capabilities?
We were on our, I would say, AI and machine learning journey prior to working with Zest. One of the things that particularly attracted us to Zest was in the credit area, some IP they have around some of the specific regulatory issues you get on explainability, on fair lending. And so that's one of the reasons that we focused our partnership on the credit side first.
And you guys may not know this about ZestFinance, but the company works with a variety of industries, whether it's telecommunications, autos, large banks. And you've been doing this for several years. So how have you seen the receptivity change to what you're doing when it comes to these traditional industries?
So I think to first order, machine learning has had zero impact on financial services, whether it's classic financial services or kind of the aliases to financial services, for example, telecom, which makes a lot of money off financing handsets. And that's, I believe, largely because no one has had a regulatory strategy. Over the last year or two, we've started to see more people engaging in the conversations. Part of the reason we were so excited to work with Discover is that Roger and his team are extremely forward-looking in a way that most folks aren't, and are beginning to use machine learning beyond just fraud, where it is today, into more complicated underwriting, particularly focused on sort of synthetic identities and things like that. So, obviously, for my company's sake, I hope everyone joins the bandwagon, but we'll see.
Talk to us about why you chose to work with ZestFinance and how the culture of a small LA-based startup meshes with that of a large traditional bank.
So as we think about talent, not everyone wants to come work for Discover, shockingly. And so partnerships is a core part of our strategy. We focus on building our own capabilities, but we want to make sure that we're working with leading edge companies, and frequently they're out here on the West Coast. And so I grew up in San Francisco. I spent my summers actually in high school coding for a startup way long time ago. So I'm familiar with that small company culture. I think it's really been about having a shared set of values, and that's where we've been very aligned. And so we have a great team internally focused on building our AI and machine learning capabilities. We have, a team of 200 in Shanghai with advanced math degrees, but we know that to succeed, you've got to partner with the best and the brightest. And it's really been very, I would say, easy and seamless working with Douglas and the team.
Is part of that driven by the fact that it's hard to recruit the top talent when you're fighting with all the big tech companies out here?
It is hard to recruit the top talent, but no matter how good you are, maybe Google or Amazon have the scale to try and do everything themselves. I think very few of the rest of us do. And so we have great talent at Discover, but we don't have all the great talent. And that's where working in partnerships is, my view on how to drive our business forward.
And Doug, ZestFinance was founded about 10 years ago, and in that span of time, there have been major developments in AI and machine learning. So how has your technology changed and the data points that you're using?
So we only use data from our clients. Sometimes we recommend that clients buy additional third-party data, but our general finding has been that I think none of our clients have ever added additional data for their first generation model. So from a data perspective, we're using what you already have more effectively, which is a big cost win. Obviously, as algorithms rev, you add them into the toolkit, but that's kind of not that hard, right? An algorithm gets revved, Archive has the algorithm, you put it in, that's just work. Where we're devoting a bunch of our time is over time how regulators and model validation folks think about the processes of validation, the processes of understanding whether this model's safe or not, while they're doing their job of assuring safety and soundness.
Right, can you get into that a little bit more? There's been a lot of discussion around the explainability of an algorithm and whether ZestFinance's data can explain why a customer from Discover was rejected or not. So how does ZestFinance make it so that the model is explainable, so that it's not a black box?
Yeah. Short answer is it's hard, and it's right at the center of our IP. There have been a lot of developments in explainability, particularly in academic research over the past couple of years that have done some really pieces of interesting work. And obviously that's super helpful for anyone who's trying to do explainability. In our case, what we want to do is make it transparent to the modeler and transparent to the user. So we have an AI model that inspects the model that you're building to figure out the various things that should be explained. And obviously you have to do it right. You have to get adverse action correctly, which means if I deny you, I have to tell you the 5 reasons why I denied you, and they ought to be correct. And if you're doing things like mortgage, we're working with one of the the GSEs. And in mortgages, you have to do a really good job of fair lending, which is to say, make sure that you're not even accidentally discriminating. And that requires another degree of explainability. All in all, that is the game. The modeling is, relatively speaking, the easy part. Regulatorily stuff and explainability stuff is the game.
And Roger, what are your discussions like with regulators right now? I mean, how are you seeing them react to the use of AI in a very high-stake area like credit underwriting?
Yeah, it is top of mind for all of our regulators, whether it's the Fed, the FDIC, the CFPB, and they are on a rapid learning curve. They bring it up at every meeting. We've done briefings for the regulators. They know it's coming. I think they don't necessarily have the capabilities in-house to understand it the way they did some traditional modeling techniques. And so, on one hand, they're excited about the power of these models to open up credit for more people, but they have, the traditional concerns around fair lending and discrimination. So I'd say, uncertainty and a real desire to learn more as quickly as possible.
Do you think that the public-facing rhetoric of regulators are different than what's being said behind closed doors? At least publicly, it doesn't seem clear whether they're endorsing or not endorsing the use of algorithms in making lending decisions.
I think they're realistic. They know that these techniques are so powerful that they are coming and that they will sort of take over financial services. So it's really how can they adjust their models, their ways of doing business to cope with this new world and accelerate that learning curve.
And
it is expected that fintech folks, like the folks wearing the hoodies, are going to insult the regulators and say that they're terrible. It's been my experience, actually, that all the regulators that I've talked to and helping educate have been trying to do their duty to the system and recognize, as Roger said, this stuff's coming, so they need to find a way to get in front of it. That's an amazingly positive perspective.
And are you finding yourself playing a role in terms of educating the regulators?
Yeah, I'm in DC roughly twice a month, training or working with or just educating folks on the Hill, but mostly regulatory agencies. And I've spent time with all the major agencies.
Do you think that there's any quiet push to prevent the technology from being used widely? Because there are so many concerns, as you mentioned, around unintentional discrimination. And there have been cases where the AI algorithms have been applied and it hasn't been explainable.
So I have not noticed a Subrosa push to stop the development. I think pushing against the tide is a kind of a hard task. I do think that there is a legitimate question of, do you have explainability and is it correct? And I think we've seen lots of examples where people ask the explainability question very narrowly, and so the answer they got was yes, but in fact, in practice, it wasn't true. You see that a lot in image search. So I don't think anything's a slam dunk yet, but no, I haven't seen a Subrosa argument.
I guess as these AI and machine learning continue to advance in their development, how do fintech companies balance innovation with this explainability that we were talking about? How do we make sure that, for instance, neural networks are incredibly complex? How do we make sure we don't get to a point where it's not unexplainable?
It's fair enough. I think the answer is we just don't. If people decide that it matters to be explainable, then they'll find ways to do it. I mean, for example, neural networks actually are explainable, and they're not materially harder to explain than a support vector machine. So there's lots of hard math out there, but there have been researchers who have really, really done a great job of figuring out how do you open those black boxes. It's just hard. And I think what some people will find out is, putting words in Roger's mouth, that it's not worth it finding out for yourself. Go find the couple of people who already know how to do it and license what they do.
Yeah.
How would you respond to that when you were thinking about this partnership and the use of this technology?
So I would say first to the question on the regulators, the explainability, the discrimination testing, those are absolutes. Right? I mean, there are downsides to being in a heavily regulated industry. I actually have started to come to embrace the upsides. I think the heavy regulation around parts of financial services are actually barriers to entry and are keeping some of us old line companies from being disintermediated, as you've seen happen to countless industries. So those are absolutes, and I don't think they're going to change. But that's why you need to make sure you are working with those few who really understand how to balance the regulatory absolutes with creating and the potential for massive amounts of business value by making better lending decisions enabled by the new models and the new technology. And so that's what's got us focused on this partnership.
And shifting gears a little bit, I mean, what do you think is the future of the credit score in America?
You know, I actually think credit scores will always be out there. I think sometimes the predictive nature of alternative data is a bit overstated. One of the things that we focused on is really pushing the credit scores out to consumers and making it so that they understand and they can start working on managing their credit scores themselves. So that's why we pioneered, you know, putting it out on the statement for every cardholder. We then shifted so that anyone can get their credit score from Discover, even if you're not a customer, and understand what those things are that you need to change to move your credit score higher. But you know, I think they will change more slowly given their importance in all the underwriting models. You hear a lot of buzz about new scores. My experience with traditional underwriters is they're very slow to make changes. And my experience with some of the newer underwriters is that brand new model that's better than anything out there, that frequently can end in tears for some of these newer underwriters.
How do you respond to that? What do you think is the future of the credit score?
So when I look back at arguably the most central innovation of the 20th century, it's two dudes, one named Fair and another named Isaac, who figured out how to use this kind of credit bureau thing and this new piece of math called logistic regression to move the world from a totally bespoke human interaction loan, right, where I would go to a bank and I would talk to you across a desk and I would try and convince you to give me a loan. And these dudes, Fair and Isaac, which may sound a lot like FICO, because that's where it came from, figured out how to use a score and yield automated underwriting, which I believe, as I said, is one of the most important innovations of the 20th century. Because all of a sudden, over that period, credit goes like this, losses go like that. Hard to, you know, you have to love that. So the question now is, but in about 1980, kind of credit availability plateaus and, you know, and losses plateau. So you've exhausted a lot of the value there, or you've gotten to a place where people are just churning too much. So the question isn't, to me, will there be a credit score? The answer is, I hope yes, because it's an important signal to people of how their credit is doing and an important prop to get someone moving to improve it. The only question is, like, what's in that score? I 100% agree with Roger when he asserted that a lot of times scores based on alternative data are more hype than reality, or more smoke than mirror. Does that work? I don't know. I don't think that works because a lot of times it is really hard to build credit models, and it's really easy to do it poorly, and you do it poorly and something bad happens at some point in the future.
Well, I'm curious what you make of the innovations in some other countries around the world, countries where they didn't have a traditional FICO score like we have. For instance, in China, there's a social credit system being built. Some people call it dystopian. Other people say that it will bring millions of people into the financial system that weren't there before. So I'm just curious what you make of these other global innovations.
So there are roughly 3 alternative credit scores in China. One's Alipay, which is the dystopian one. One's provided by Baidu and one's provided by JD Finance. Baidu and JD Finance use our technology to provide those scores. So I'm a little bit required to say that they're awesome. Thanks for laughing, you guys. Come on, this is going to be so boring if you don't laugh. Come on. But I mean,
you also mentioned there's also the national social credit system in addition to the
right, which is sort of pushed. It was sort of being funded by, or not funded, but powered by Ali. So there's like some. I think it is a truism that there are a lot of people in all countries, 80% of Chinese, but also 40 million people in the United States who are poorly served by their current bank, and some number of those people actually are good credit who have been marked as bad credit. And there is a moral beauty in finding people who are being mistreated by the system and fixing that. So my hope is that it will continue to crank.
And on that point, as you see this partnership play out, how are you forecasting the new customers you can draw in?
So I just want to circle back. I find the concept of the social credit score or the social score very interesting. I would point out that it's already here in the US. it's just distributed. But you know what someone's rating is on eBay, you know what their rating is on Uber, you know what their rating is at Airbnb. It isn't too big a leap of faith to see those starting to come together. And when you're transacting with people you don't know, when you're no longer borrowing face-to-face with someone who's been in your community forever, you do need some way of knowing who am I dealing with and are they a trusted counterparty in that transaction. So it'll be interesting to see how it evolves here in the US as well. You know, as we look at our lending and leveraging the capabilities that we're building, working with Zest, I think, you know, the easiest way to think about it is it just helps you swap in and swap out. Right? There are people that we are approving in our traditional models that we shouldn't be approving. There are some people we are declining that we shouldn't be declining. There are more people that we're declining, so the net result is actually an increase in credit availability, but we're, you know, very excited about the early potential we're seeing.
And shifting gears a little bit again, Discover's been pretty open about working with Amazon for moving some of its cloud capabilities. So how much of your business has actually been shifted to the cloud, and has that helped partnerships with companies like Zest?
Yeah, so I would say similar to most, you know, old-time companies, it is a journey to migrate your applications to the cloud. But from a data and analytics standpoint, everything we're doing there is cloud-based. So all of the work we're doing on the partnership side, and quite frankly, there are no alternatives. You cannot get the speed, you can't get the performance, you don't have the toolkit, and you just can't get the scale to store the vast amount of information the vast amount of data that we need and that we're leveraging working with Zest.
And how are you in the industry looking at this potential concentration risk? For instance, there's only really 4 players you can go to for migrating your cloud services. Is that a concern?
You know, I think over time, companies will have a multi-cloud strategy. So you see a lot in the migrations, and Douglas is much more of an expert than I am. You know, people will pick a single cloud provider for the transition, and that's the fastest path to value. Over time, you may not want that reliance, and so you'll have a multi-cloud solution. You know, I'm not sure there's any more risk than your data was concentrated in your own 2 data centers. So, you know, most large companies don't have more than 4 data centers that they were using for their traditional approach. And so I would view it as actually, given the redundancy that's built in, less risky than kind of where you were before migration.
Doug, would you agree with that? Do you think regulators view it similarly?
So I think it's still early days. I think the regulators are still sort of finding their way around cloud. But I think on growth, it is so much safer than running your own data system, data services, that everyone's going to get there. The cost also is just so radically different. You're going to, again, shouting at the tide doesn't help you. Eventually, everyone's going to be on some variant of the cloud.
And Roger, you're starting out with this partnership, but over time, how do you see AI being applied more broadly across Discover services?
Yeah, so I think AI, and you talk about AI or machine learning, I see it touching every part of our business. You know, Douglas talked about the earliest applications are on the fraud side. I think that's been part of the fastest path to value for organizations. You've all had the experience of either fraud on your credit card or being declined for a transaction that was you, and you think, gosh, how could the company not know this was me? So a lot of potential on the fraud side, a lot of potential on the marketing, but some of the benefits are more subtle. So if you have the experience of calling a call center and that representative somehow really understands your issue, you don't have to get transferred to level 2 support, you don't have to get transferred to level 3 support, you get the help you need. There's probably AI that's driving that customer interaction, that's providing the information for the representative. So we see it as truly pervasive to every touch point we have with the customer. We've done things such as shifting, you know, we probably had 100 to 200 people on call quality, monitoring calls and listening to a sample of calls. Leveraging AI, we now listen to every single call and queue up the ones that have compliance issues so team leaders can talk to their representatives. So just, you know, touching every single part of the business model.
And I'm curious, in the audience, raise your hand if you work at a fintech startup. Raise your hand if your company is partnering with a big bank or is interested in partnering with one. So I'm curious what advice you'd have, Roger, to a startup that's interested in being integrated into a large organization. I mean, you mentioned that there were discussions a few years ago, there was some back and forth. What really makes it to the finish line?
So I think two things. It's really what you have to sell and who you sell it to. It's really about solving a problem. If you can show convincingly that you have a product or a solution that's going to create value for a big bank, that makes the sale much easier. So part of it is understanding their business model, reading the analyst reports, and knowing what are the pain points for that organization. What's going to help them grow faster? What will help them take out costs? The second thing is figuring out the right person to talk to in the organization. And I'll use Douglas's failed sales approach as an example of that. People frequently think that if you can just talk to the CEO or talk to someone really senior, that'll solve all your problems. That usually isn't the case. They are probably not making the decisions. Sure, their support would be helpful, but they're not making the buying decisions. So it's finding the right person in the organization, and that's the advice I'd share.
Do you agree with that? Any additional insights?
No, I think that's right. And when we found the right person in the organization at Discover, things moved quite quickly, actually. I mean, I think I would give the same advice that I give to any other kind of technology person, which is ultimately selling is hard, and it's uncomfortable for introverts, and many technologists are introverts, and you have to stand by your guns. If you have a solution which provides value, someone's going to write you a check, and if you don't, go solve some other problem.
And we have a few minutes left here, but I want to pose this question to both of you, but I'll start with you, Roger. So at Bloomberg News, at least, we've been very focused on the forays of Apple, Amazon, and Google and their pushes into financial services. So I guess more broadly, of course, these companies are partners, some of them, but how do you view their deeper pushes into financial services? For instance, Amazon's already in lending. We just had the announcement about the Apple Card.
Yeah, I think that for better or worse, there is a regulatory moat around large parts of the financial services. Alternative lenders have been very successful getting into personal loans because those are easy to originate, to fund outside of a bank structure. You don't see that in the credit card space. So Apple, is launching their card. They're leveraging a traditional credit card network and leveraging a traditional bank to bring that product to market. And so I don't see that regulatory environment changing. So the answer is really about those partnerships. And we are out there working with just about any one of those big companies you name, looking for ways to either leverage our payments network and provide payments functionality, or leveraging our bank charter. And the experience I've had, there are a lot of companies that think they want to get into banking. Once they understand the margins, once they understand the regulatory overhang and what you have to do, they pretty quickly come around to partnering with a bank as an easier way to get there. And that's where we try and come in, and that's where we've seen great success.
And Doug, how would you view the trends of late?
So I was asked recently, do I expect to see a flood of fintechs applying for charters or a flood of fintechs becoming banks? And my response without thinking was, oh my God, I hope not.
There are a few out there.
Yeah, maybe one. So, it's really hard to be a bank. Like, it requires a lot of work. And, one might be willing to try and insult the current banks if one wants to, but when you look at it, it's hard to run a payments network. It's fragile and has to be fast. It has really low margin. And it's like everyone looks at banks and says, oh my God, there are all these high margin businesses. Well, yeah, but that's because the cost of capital is basically zero, which helps a lot. So I think my hope is that the fintech side of the fence will busily help the banking side of the fence continue to grow and be more profitable, et cetera, because that just means more sales targets for us. I cannot imagine a world in which I would want to become a bank.
All right, well, that just wraps it up. And thank you so much for listening and for your time and for the great conversation.
Thank you.